Well, I think the next 2 months are going to be a lot choppier. And I do sense that we could have a 5%, maybe 10%, but I think at least 5% move probably starts in October into November. At that time, I think you do want to buy dips, and I think the market likely goes higher into year end, if not probably the middle part of January. I do suspect that heading into next year, if we finish on a high note, that we probably will have a first year correction.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest was last on this program back in May, he made the bold prediction that new all-time highs for the stock market were just weeks away. And he was right. And since then, markets have continued powering higher, trading at a new all-time high the day of this recording. So, is he still bullish on the market's prospects for the remainder of the year? To find out, we're fortunate to welcome back to the program Mark Newton, head of technical strategy at market research firm Fundstrat, where he works with its founder, Tom Lee. Mark, thanks so much for joining us today.
Thank you for having me back, Adam. Great to be here.
Thank you. Well, look, first and foremost, congratulations on the correct call that I just mentioned there in the intro. At the time, wasn't, a crowded call. And you kind of stuck your neck out there based on your technicals. You're a big technical guy, and you were proven right. So I want to give credit where credit's due.
Great, thank you.
All right. I got a number of questions for you, but I'm just going to start with the money one, which is, as I mentioned, you're a technician. Last time we talked, I really got from you that you take macro into account, you think about all this stuff, but really at the end of the day, you just do what the market technicals are telling you to do. So what are your latest technicals telling you in this market?
It's been an interesting month or two, I would say, for the US stock market. Looking at the market back in April and really in May when we spoke, there was still rampant signs of fear. The fact that technology had come back with a vengeance really gave a lot of confidence to the idea that markets should start to turn higher. I mean, sentiment at that time had gotten almost as bearish as what we saw at the 2022 low, as well as at the COVID low back in March of 2020. And going past that, it would be almost 2002, 2003. And so there was only a couple times in the last 20 years where sentiment had truly gotten that negative. Fast forward to today, sentiment has improved ever so slightly, but still largely neutral and arguably still not as optimistic as what many would want to see to think there's going to be any sort of major top right away.
All right. And sorry, Mark, are you talking consumer sentiment, like the UMIS surveys? Are you talking investor sentiment? What are you
Yeah,
looking
I look at a combination of those. Obviously, we've done some studies on the UMISH survey, and when you look at consumer sentiment, there is some political bias to that, and that has been pretty chronically negative compared to how it looks over the last 20 years. But I look at a combination of several things on the retail side, like um, American Association for Investors Intelligence. AAII, I think, is interesting at extremes. I think the fear and greed poll is very, very good. I look at sort of the slope of the VIX curve. I always want to look on the institutional side for what the CTA exposure and some of the really the short interest as a percentage of open interest. What's happening with Bank of America portfolio manager surveys. I look at a JP Morgan poll. I try to put it all together and just also looking at option skew. And so, I don't see evidence of rampant speculation right now and or evidence of real froth with regards to sentiment. I think that obviously under this administration, there's sort of a new ballgame with regards to how we view sentiment. I think a lot of people remain largely pretty guarded and fearful of tariffs and what's going to happen to inflation. I think a lot of that really has not mattered to earnings nor economic data. You could argue that, potentially the economy is starting to show evidence of rolling over ever so slightly on the fringes. Obviously, the labor market has been weakening of late. People have stopped hiring, but yet we don't see mass layoffs. The data today on continuing claims and jobless claims was actually pretty encouraging. So I would have to argue, and the Fed obviously has still indicated they're set to really cut into this economy, to the tune of about 4 cuts by next summer. So, it's an interesting spot we're in where earnings are very, very good. The market's hitting new all-time highs, but yet the Fed's going to cut, 2 more times potentially by the end of year and another 2 times between now and next summer, or between beginning of year and next summer. Um, Technically, how I look at things, I look at things like momentum, breadth, obviously technical trends. Right now, those are still quite strong. There have been a little bit of breadth rolling over in the last 2 months. It is important to note that because the market largely is unchanged on an equal-weighted basis since late July. So it has been technology and communication services that have done a lot of the heavy lifting of late. Some of the companies within data storage, the Western Digitals and Seagates of the world have really helped to drive technology, whereas, the former leaders like NVIDIA have been range bound since July. So those are no longer, at least the area that's helping to lead the market. And it's still, 7.5, 8% of the S&P. So, for me, it is encouraging to see other areas within technology start to rise and take the lead. There's been a little bit of bifurcation there, but tech does have the power to take the market higher, regardless if nothing else is participating. In this case, there have been other things that have made slight progress, but that's one thing I'm watching that might be to some extent, a minor warning sign over the next 2 months was that the breadth has started to falter ever so slightly. We've also gotten technically, how people like to say overbought. So when I look at relative strength index on a daily basis, on a weekly basis, we're now officially in overbought territory. We're pressing up towards the highs of the multi-month uptrend channel that goes back since the spring, and that hits up near 67.20 or so for the S&P. So my own view is that the upside should be a little bit limited over the next few weeks. I think that we are getting into a seasonal time where cycles and seasonality are going to put a downward bias in this market, but I'm still really premature at trying to make any sort of short call or time to raise cash. I think that, the movement in tech has been strong. My own view is that that happens sometime in the month of October and mid-October, which would be in a 6-month window from where we bottomed. And my own cycles say between mid-October and mid-November is the key time for weakness in the stock market this year. So if I had to look over the next 2 months, I say there's a good likelihood that markets will be down, but I don't think the next probably 2 or 3 weeks are going to be down. I still think we're probably going to find a way to push higher into October before we see any type of even a mild pullback. And so, looking all in all at all my indicators, momentum is still strong. Technical trends are strong. Trends are really the most important thing. And when I look under the hood at sector rotation, having technology lead the market yet again is a good sign. Sentiment also, from a contrarian perspective, is also a good sign because we have not gotten terribly enthusiastic. I say the one thing that you could say in the bear's favor here is that you have started to see evidence of some of the meme stock speculation and this and that ever so slowly starting to lift. You obviously see a very good move in small caps. I would not argue that's a sign of true speculation, but we have interest rates now coming down. And so obviously these smaller capitalization companies that have a much higher ratio of debt to capitalization certainly benefit with floating rate, corporate structures as rates come down. And so small caps kicking into gear along with mid caps is definitely a good sign for the stock market at large. The times I worry were like 2021 when I turned bearish in November of that year and in January, expecting a 20% sell-off, was that market breadth had really begun to roll over and it was really only technology that was participating. So far fewer stocks above their 200-day moving average, so to speak, and sentiment had gotten very, very optimistic into end of year, really November, December of 2021. That's typically what I look at to say, okay, markets are really, really getting vulnerable. For now, with rates coming down sharply on the long end and still the short end, I guess the yield curve has started to steepen out ever so slightly again. Um, I see that as being a force of good news for home builders, for those seeking to refinance mortgages. And I think that we shall see if that can truly help to stabilize the housing market, which my own cycles say should be due to peak as of next year and go into about a 2-year decline. Now, we've already started to see housing in many parts of the country start to stall out, and certainly supply has been elevated. Homes have gotten to really unsustainable, I would say, prices. And the interest rates have now largely doubled with regards to mortgage rates over the last 2 years. There's a reason why my wife and I actually sold our house last August. But the Northeast, where I live, has not really felt the burden of that like the most of the country. And so we have not enjoyed the same kind of appreciation on the upside. And I would argue we probably also don't see the kind of decline in home prices. But arguably, if rates are going to start to come down in earnest, we know on the short end they're going to take rates down. But really, the question is whether the economy is going to really start to roll over and weaken substantially, and or if inflation is just going to continue to prove to be a non-event. My own forecast for rates is that we're going to continue to fall between now and end of year before a pretty good bounce in both rates and the US dollar. For now, the dollar pulling back, rates pulling back, arguably still quite bullish for equity prices, as well as for asset prices in general. Emerging markets have thrived. We've seen precious metals. I know you're a big silver bull. I own some silver and gold as well. That has done quite well. So crypto has done well. I just sort of struggle. I sense that we are sort of nearing a time when we could be nearing a short-term inflection point, but we have just yet to see any real trend deterioration. And I have to sort of lean on long-term trends as well as short-term trends and say until that happens, I feel like the S&P probably still has another 75 to 100 points higher, and then I feel we're probably going to have to consolidate this move in October.
Okay, thank you. So just want to confirm a couple things. Sounds like you're saying you have some immediate term, this market can still go higher. But as we head into October, November, it sounds like your default assumption is that things are going to cool off a bit in the markets. I don't get the sense that you're calling for like a 20% kind of correction like you were heading into end of 2021, because the froth isn't there in the way that you saw back then. And I'm not quite sure how I would consider your outlook for, say, the year of 2026, and maybe you're not looking out that far anyways. I don't know.
I think that I'm going to save a lot of that commentary for probably year end when I do my annual review. But I'll just say that a market that's up largely 20% for 2 years straight, and if we finish this year near our highs, we'll have to undergo some consolidation. We're really nearing the end of that 4-year cycle, and of course, we did see pullback in 2022 and to some extent in 2018, and at least some choppiness in 2014 and this and that. So I think that. I do suspect that heading into next year, if we finish on a high note, that we probably will have a first year correction. I'm sort of unwilling to say that we're going to go down in a big bear market and things are going to get really tough. And a lot of that just has to do with intermediate term, strength in AI, which obviously is something we still have to respect with regards to earning strength and also just technical strength. And many of these companies continue to impress on the upside. So, to look at it overall, I came into the year last January with a target of 66.50, and we're largely right here, of course, with about 3 months to go. What does that mean for now until year end? Well, I think the next 2 months are going to be a lot choppier, and I do sense that we could have a 5%, maybe 10%, but I think at least 5% move probably starts in October into November. At that time, I think you do want to buy dips, and I think the market likely goes higher into year end, if not probably the middle part of January. And when that happens, if the S&P gets up close to near 7,000, I sense that we'll probably see some real enthusiasm for the stock market and just think, well, everything we thought we knew about how tariffs would work or about how Trump would work as president is just about him being bearish and it's the end of the world. All this stuff is going to prove to be wrong, and we're all in now on stocks. And I think that's probably a time to worry, is probably the beginning of next year versus right now. So I'll believe it when I see it. I mean, to start to see evidence of real technical price weakness is really the first thing that, people like myself want to see. And until then, we just sort of have to lean on the fact that earnings continue to beat a very low bar and are coming in better than expected, and the economy is still holding up better than many expected. And technically we're in a bit of a an upward, melt, as they say. We're largely have been melting up since the beginning of September. We've ignored a lot of the seasonal weakness that we usually see in August and or September in
Hmm.
post-election years. And I had written that, if things are going to happen, it probably starts sometime in mid-August and churns, and then we push higher. And while I didn't turn bearish, I have been a little bit defensive in the last few weeks, and just noting that breadth has dropped off and that we're getting stretched. But overall, that's not a time to say to clients you want to take all your money off the table. It's more just to not, be too late to leave the party, and don't be the one standing next to the punch bowl. And so I'm bullish, but I'm a little bit more cautious, I guess, from a just a cyclical perspective than the last time we talked, because I do still feel like we're in a time when something could happen, but I sense we're probably a month away. And then I think we probably have a drawdown into November, and you want to buy that. And then I'll leave, I guess, my 2026 commentary for December.
Okay. Hopefully your schedule allows, Mark, if it does, you to come on this channel at some point in December and share that with us after you've shared it with your Fundstrat
Yep.
clients, obviously.
Yep.
But would love to hear it. So a couple quick things. One, I want to make sure I didn't misstate. I know you study the macro environment, but in terms of kind of your market calls, you base those primarily based off what the technicals are telling you, right?
Technical analysis, meaning the study of price action, trends, momentum, breadth, sector rotation, as well as just seasonality and cycles, and just really leaning on sentiment and cycles as really being things that are probably the most important for making bigger calls on changes of trend when we haven't seen any evidence of the trends doing so. So that's right. I don't put much stock in almost anybody's ability to be able to accurately call the economy, just given the data that we look at that continues to be backward looking and constant reversions, and just I think it's a bit of a mess post COVID in terms of how to accurately get a feel for what we're seeing. But the data, to me, and I'm not an economist by any means, but the GDP has held up a bit better than expected, and inflation has continued to be sort of pushed off. And I sense that heading into early next year, you could have a small spike, but I still see crude pulling back to the low 50s, and that's been a force that's really taken a lot of the steam out of the inflation.
Inflation, right? Yeah.
Yeah.
So let me ask you this, Mark, just as an example. If Mark Newton, the man, is looking at the jobs market and seeing signs of concern that it's weakening and could get worse, you're not going to let that necessarily influence your trading outlook until and unless you see the technical price actions start to reflect that, right?
Yeah, that's correct. Look, I always advise clients to put all these extraneous, exogenous factors to the wayside, and put the blindfold on to what the media is saying and or the economists, and really just concentrate on trends and the sector rotation, and how are stocks doing in your portfolio, what's moving, and the interest rate market and the dollar. I think that's a lot more important than trying to think that any of us can accurately predict what the economy holds in the months to come.
Okay. All right. Well, then let me ask you just on sort of technical indicators. This is a pushback that I think maybe some viewers would have to your earlier comment that you say you're not seeing a lot of signs of speculation in the market right now. And I get you're saying kind of relative to where we were at the end of 2021 when everybody was just buying, it was going to be sunshine and rainbows forever.
Mhm.
But as you've mentioned, by lots and lots of indicators, the market seems to be quite overbought short term, right? Um,
Well, overbought doesn't have anything to do with sentiment, but yeah, in
no,
general.
yep, it doesn't. I'm just going to mention a bunch of indicators and I'll let you respond.
Yeah.
So market is short term, appears short term overbought by a lot of indicators. Um, just nominally, we have a lot of indices and stocks at all-time highs, which in and of
Right.
itself doesn't mean much. If you look at valuation ratios, though, by a lot of standard valuation ratios in terms of, hey, how richly priced is this market or not, they are quite near or at all-time highs.
Mhm.
We've seen some crazy price action of late. I think I've got the company's name right. I think the company was a smaller company, was MMMC or whatever, but they announced that they were going to do a kind of a crypto treasury thing, right?
Yeah.
And their stock was up like over 2,000% in a day. We had a massive blue chip tech company, Oracle, give guidance and then basically shoot up by 40% in
Yeah.
a matter of hours, right? And to your point, we've seen meme stocks begin to come back to life. SPACs are back. We've seen a lot of interest in capital influx into cryptos.
Mhm.
So a lot of people see that and say, hey, that feels pretty speculative to me.
Right.
So what would your answer to all that be?
I think a lot of this has just been recently starting with regards to some of this so-called meme stock speculation. I think to that point, while some of these have come to life, crypto is something that many, I think, still really aren't that comfortable with. If you ask any of your friends, I have a ton of friends, that locally and all, whatever in my area that, and still a lot of them don't really own crypto. And so, yeah, I get the fact that a few of these have spiked up dramatically, but, that's a slow process. That's not something that I would look at. With regards to all-time highs, I don't see that as being bearish. I mean, as a pure technician, you know, listen to what William O'Neill said. It's also in your state of California. It talks about, he studied some
My old state of
your
California,
old
just to
state, not the
clarify
new
for folks.
state,
Yeah.
right? Congratulations to you on that, maybe, right? Or not?
Thank you. Yeah. No, no, no.
I,
It's good.
but he wrote a book called How to Make Money on Stocks, and he studied, hundreds of stocks like Amazon, Intel, or whatever you want to call it, Microsoft over time, and he said they all had one thing in common before they went up 300 to 400%. They all hit brand new all-time highs. So when I hear all-time highs as being something that anybody would consider to be a negative, we all want to own where the momentum is. Momentum has been the number one factor over the last 2 decades in the stock market.
Right.
It's not buying mean reversion and hoping that these stocks that are below their intrinsic value are somehow going to rally when the volume and the institutions are just selling them. It's very, very difficult to make money trying to buy low, sell high. It's really a misnomer. One should always be buying high, selling higher, avoiding things that are going low and or shorting those to cover lower. At least that's my own philosophy. And people like Andrew Lowe from MIT have written papers about this as being, statistically accurate and something
Yeah.
that happens. Anyway,
So I'm going to interject for 1 second because I want you to keep expounding. I just want you to take this data point into consideration. So buying high, sell higher, I get it as a momentum investor, but what you got to be careful about is that you're not the greatest fool who's buying in, at the last moment, right? And that's where we get to the valuation metrics. And I could put a whole bunch up here, but I just want to put this one up here that I just saw yesterday for the first time. And it's the weight of names in the S&P 500 that are trading above 10 times their
yeah,
trailing 12-month price to sales, right?
right,
So I believe this is market cap weighted. It's not the number of stocks in the index. It's of the stocks that are trading above 10 times their
right.
price of sales. What percent of the index does this make up? And you'll see here that we're at an all-time high. And so this would indicate the market here is pretty richly valued because the only other times it's been even near here was right before the dot-com bust and right before things rolled over at the start of 2022, and we are much higher than those two peaks. So how do you take stuff like this into account?
I don't think it's ever worthwhile to pay attention to that. I think that we're in a new era of AI, and I think it's very difficult to put a figure on valuation, particularly when, all the indicators that I look at for sentiment or indicate, AAII just came out and it's still bearish, and it's been bearish for the last 2 months. people are not all that enthusiastic about the market. CTA exposure, while it's been forced to follow the market move, they've adopted measures to expect a correction, and we've seen that in the put skew, active hedging. And so, I get that whenever I ask people, how do you use intrinsic value? Let's say you think a value of a stock is 30. If it goes to 35 or 40, are you going to be selling that stock? And then how about if it goes to 100? What do you do then? How about if it goes down to 25? Are you going to be buying it if you think it's worth 30? Is that a good time to buy? And honestly, this all has to do with the difference in methodology and discipline, because I am never buying extreme weakness and sitting for weeks and months for things to try to rebound. And a case in point, stocks like PayPal or Salesforce.com or any of some of these software companies that have lost their edge and they haven't caught up with the AI story, and the stocks have been punished. I mean, many of these just aren't, you would argue that, oh, they're down off their highs and it's time to buy. Honestly, you want to be owning things like data storage right now and what's happening with the Seagates of the world and Western Dig, and they obviously have been outperforming. It doesn't mean they're a sell just because the stock price gets overbought. Or the problem I have with fundamental analysis is that all these analysts cluster together with their targets, and if you have a couple of big people on the street, all the other guys say, well, they're all at $2 a share, so how in the world can I value this at $3 a share? I have to sort of figure out what I'm doing wrong and come in. And so when these companies tend to exceed the estimates dramatically, everybody's left scratching their head. So fundamental analysts always go to bed upset because they think that something is either extremely undervalued or extremely overvalued, and they can't be at peace with that. Technicians like myself, on the other hand, go to bed knowing what the trend's doing, and you stick with the trend until, and that might sound simplistic or naive, but honestly, in the long run, uh, you showed me the picture of a giant breakout of 2,000 highs. Does that make me think it's going to mean revert right away if it's just gotten to the highest level of all time? The PE arguably of the market is right around 26. It's not where it was back in ahead of the dot-com. When you look at the Exodus Communications and all these other stocks that are trading at,
Well,
Cisco is trading at 100 or trading at 150 or 200. So arguably, the PE of the market is not, if you strip out the AI, which is probably the most important area, but it's nowhere near where we were in 2000. And so, the biggest problem that I have is probably the degree of debt that the economy has and the reluctance to cut spending. And I think eventually that will catch up to us. But that's also a problem that's not going to affect the market on a day-to-day basis, and
yeah, that's
something.
an unknowable in terms of whenever that's going to matter. I think we all agree it'll matter at some point. Yeah, but when?
So let me ask you a question. So if the
Yeah.
market's at 6,600 and let's say we all go to cash, and so let's say next year we go to 7,000 or 8,000, I mean, what service have we done to our clients to be negative while the market just goes up and up and up? And it's like we have to use trend following and technical analysis and our discipline as a part of that, or else we're doing a disservice regardless of what our beliefs are, because things continue to move in ways that most who have learned Wall Street fundamentally are never going to be there and buying highs. They're always going to be wanting to buy dips because they see things as good value. We always want to be buying low and selling high, but that's precisely the opposite of the way you want to invest money.
So I totally get this, and again, let me again commend you for your approach working so well this year. Um, as many experts on this channel say, which sort of echo what you're saying, which is, you know, I don't know if you would say this, but I think you might, which is that valuations matter in the long run, but they are terrible timing tools. So to your
Yeah,
point,
100%.
yeah. And all I wanted to know was how much do you take into account at all when we are heavily deviated on valuation metrics? And what I kind of heard was I don't really, right? That your methodology is both momentum in terms of what the tape is telling you, but I also get the sense it's pretty heavily influenced by behavioral economics, and that's where I see sentiment playing a role, right? And kind of what I've deduced from what you're saying is look, I've seen enough of these cycles where I know how crazy the party can get sentiment-wise before it ends, and we're just not there yet. Is that
That's
fair?
completely fair. That's completely
Okay.
fair. Yeah. So if we start to see real breadth erosion, we start to see technology really start to roll over sharply. The market's very thin, nothing's working. Sentiment is really, really bullish. Then when we start to break down, then you have to respect that. But as somebody that tries to make clients money really over the next few weeks to few months, and I want clients to always be in things that are going to be helping to add alpha, where they're making money for their clients and making money for themselves. I just don't have a lot of confidence that using valuation data as being something to try to keep people on the sidelines when it just hasn't proven to be effective as a timing tool.
Got it. So some people, some folks will look at data like that and say, I'm still going to be in the market, but I'm going to dance a little closer to the door. Like I'm going to be on the dance floor, but I'm going to stay a little closer to the door. I don't get the sense you're saying that. You're saying I'm not going to move closer to the door until I start to see some breakdown in some of these key metrics you look at.
Yeah, I guess
Key momentum metrics.
on a short-term basis, I'm probably a little closer aligned to that theory between now and November, say the next 2 months. I do agree with that because I know
Because your indicators are telling you that October, November
yeah,
may be
that's
low. Yeah.
right. So I do sense that that can happen. I guess 2 months is probably short term based on how you and maybe other people would look at it. But it's something where if I look at over the next 4 or 5 months, there's just not enough warning signs yet in my work. And I think those will be, it's not like we'll miss those. I mean, those those are very clear to see ahead of time. And sentiment, regardless of what you look at, there's tons of polls. Most of them are neutral at best. Even the CFTC data on S&P futures shows people net short now as a percentage of open interest on across different indices. It makes me real reluctant to think that markets are going down right away because all those things have proven wrong. Why should they suddenly be right? Right? So
Yep.
valuation is proven wrong again and again and again. And everybody looks at valuation differently. So I guess Robert Schiller probably is one of the more interesting people to read about his books on socioeconomics and how he values things. And so I don't tend to use the traditional metrics on saying everything is really extended and we're going to go into a bear market. I think it's a little premature. And if you study the longer term cycles, it doesn't suggest that 2025 was ever going to be a down year. It's the best year of any given decade in terms of decennial cycle pure theory. And given the
Yep.
negativity, as we head into the next couple of years, it is a little different story heading into, the pre-election year and the election year, and we'll see what those have. But the
Yep.
midterm year typically is really one of the worst of the 4-year cycles, and that's coming up next year. So
Okay.
I would have an easier
And you're
time
saying that as an analyst or a student of market technical history, right? That in
correct.
the, the average of these years over a 10-year period tend to perform in a certain way on average, right?
Almost always, if you look back over the last 100 years, the midterm year has been one of the worst of the 4-year cycle. And this year, being the fifth year of a decade, has been the best. And so it's not surprising to me. I clearly, even in my interview, I don't think I call for markets to go to and hit my year-end target by September. I think it's been a remarkable move. It's surprised even myself to the upside. And
Yeah.
so now you have to say,
But by the way, are you moving that up to 7,000? Because you mentioned 7,000 earlier as a
yeah, I
potential.
mean, I don't see a lot of value in doing things like that. Honestly, what I'll do is after I think we get a correction from October to November, then I'll probably look at it and try to make a best case example. I mean, I put out a number once a year. I try to stay with the here and now and sort of manage risk tactically and how I look at markets. So I don't think it's always wise to think that year end really matters. So I'm still where I am. I just think we'll probably maybe we go to 6,700, we pull back a little bit, we run up to 7,000, and then maybe the market has an earlier peak. But I don't like to speculate like that. I want to let my indicators and the trends really help me in that regard.
Okay. So I want to ask you about a couple of asset classes that I've seen you and your firm talk about recently. Real quick though, so I would say that viewers of this channel, Mark, are they watch these videos to become better informed and hopefully make
Yeah.
better decisions in their investing. And obviously, they want to grow their wealth, but they want to do so prudently. And I would say, because 2/3 of the viewers of this channel are over 45 years old, they're either nearing closer retirement or in
Yeah.
retirement. And so more so than prudent growth, they just want to make sure that they don't get steamrolled by
Right.
a market correction, right?
Yep.
So if I heard you correctly, you said that your model actually told you to anticipate some sort of correction coming into 2022. Um,
Yes. Yeah.
just
Actually, if you look at a CNBC interview, it's called, it's actually Tom Lee. I had been with the firm 2 months, and it's called A Turning Point. And I had joined in September of 2021. Actually, we're 3 days away from my 4-year anniversary. So I told
happy
Tom
anniversary.
there'd be a correction, and he went on CNBC and said, I think my new guy Mark Newton here thinks the market can sell off, and everybody's like, "Oh, Tom Lee bearish? What do you mean?"
Yeah.
And that was the peak of the Nasdaq, the Dow Jones Transports, the Russell, most of Europe, everything but the S&P peaked on November the 17th of 2021. And of course, the S&P peaked in the first couple of days of January. But I called for a 20% drawdown down to I believe 3,500 by June, and that proved right. But it's not a matter of taking a victory lap. It's more about just I'm not. I don't consider myself a perma bull or a perma bear. I focus on trends, and the trends for the last couple of years have been, thankfully very good. And I've been bullish and optimistic since 2022. And, we'll see where that takes us. And maybe I'll have to make some adjustments heading into next year, and we can talk about that in December.
Okay. Well, yeah, you're kind of a version of Joe Friday. Maybe we'll call you Joe Saturday, where instead of just the facts, ma'am, it's just the trends, ma'am, right?
That's right. Well, yeah, to some extent. Yeah, exactly.
All right. But I think you've just answered, but I wanted you to speak to how successful is your methodology at not just anticipating, continued run-ups in the market, but also anticipating potential corrections. Sounds like it's got a pretty good recent track record.
I think people have been very happy with this. I think that we at Fundstrat present a very complete view where Tom Lee does a lot of the longer term, top-down sort of macro, looks at inflation. I, of course, am much more tactical and shorter term, and so I have the ability to be able to talk about things going, up or down in several different asset classes. And I think that complements each other. People like to make decisions on their own. They're given a lot of really good data. And so, it's not always for us to hold people's hand, but it's more like this is what we're seeing, this is where we're right and where we're wrong. And it's up to you to make that decision on how you want to invest your own money. But these are our this is what we like. And so we try to each month come up with a list of sectors that we like. And, I specifically write about interest rates and the dollar and precious metals and oil and what I think about crypto and stocks. And so, it's been a very good 4 years for me. I'm very happy. I joined these guys. I've been on my own for a number of years. I traded equity options at the CBOE in Chicago for a while, and I was with a hedge fund, and I ran Morgan Stanley's technical department in New York back in 2006. And so this is a wonderful firm. It's a great platform, and love to talk to people about what I'm seeing, and it's really resonated. So.
Great. Well, congratulations. And I chuckled there because you pretty much just listed off the assets I wanted to ask you about specifically.
Yeah.
And we don't have a ton of time left, but
Great.
so give your answers however much time you want. I mean, we're not, you're probably
In,
happy.
in general, I think that the dollar and rates have one final flush that's going to happen really between now and October. And thereafter, I sense that they're both going to start to turn higher that lasts probably into the early part of next year. So that indicates that, you know, yields coming down historically has been very, very bullish for stocks. There's been some good correlation there. I sense that if yields now start to turn higher, probably by next month, and also with regards to the dollar, that could be at least a technical catalyst, looking at correlation for why the stock market, might start to weaken a little
Might
bit.
start to weaken. Yeah, that makes sense.
So I in general am bearish on both the dollar and yields, probably over the next 6 to 9 months. But I think we're heading towards a time when both are going to start to bounce, and I think that probably starts in about a month. I think with regards to precious metals, I've advocated being long both gold and silver, more so silver, which has played catch up with gold and has started to show more outperformance. My own cycles say that those are due to peak out in the month of October. And so I sense that also happens because rates and the dollar start to go the opposite direction and go higher. And so I do think gold has gotten very, very overbought using my metrics. I had a 3,800 target. We're almost there. Silver, I still think both of them push higher over the next 3 or 4 weeks, but I'd be probably a little bit closer towards taking profits and just watching carefully for evidence of trend damage in the metals, which I don't think are going to be able to carry up indefinitely through the end of the year. I do sense that we're going to have a pullback in the metals as well.
Well, I mean, they were up
You
40+% this year. Curious on that.
Yeah,
So peak out maybe next month, maybe a rocky end of the year
yeah.
or volatile end of the year. From a trend perspective going into 2026, do you expect them to run up, or do you expect them to get under pressure because you expect rates and the dollar to continue to strengthen into 2026?
Yeah, I think that the strengthening probably lasts for the first few months, and that could coincide with weakness. So even though gold historically has had a good December, I think that the metals probably are within a month of peaking out and start to turn down. I would look to buy weakness into probably the middle part of 2026 because I do sense that for a number of reasons, central bank buying, the deterioration of the dollar will be a concern. People want to own hard assets, lack of independence for the Fed, some concerns about fiscal sanity, I guess, in the US and continued spending. There are a lot of reasons why you want to own precious metals, but it's been such a great year and gold's been going up for, 2.5 years. And so it's just a matter of watching the cycles, and most of them are going to start to turn down later this fall.
Okay. And this, just so you know, this comes along my advice to people of late that they've had a great run. Nothing goes up in a straight line. You know, time to at least consider rebalancing, taking some profits, or putting on some hedges. Sounds like your model is saying probably wise to at least consider that at this point.
The cycles say that, the trends do not. And so I always lean on trends first and foremost. So I'm still expecting a big move over the next month, but then I'll probably, people like myself that watch the markets daily like to, hope that they can try to top ticket when a few things come together. So I think there's a better opportunity or risk reward for selling that probably comes about, in a few weeks, maybe 4 or 5 weeks. But I think, there's a possibility that both metals and also the S&P might go down at the same time because rates are starting to rise again. So that's something to keep in mind.
Keep in mind. Absolutely.
Yeah.
Okay. How about oil?
It's funny because the cycles start to turn higher in crude, but a lot of the fundamental data on the supply and even the technical trends are still very negative. I sense that we have one more move to the downside, and I sense that happens really between now and October also. I think that crude likely gets down to probably $58, $59 from 63. And thereafter, I think we probably are going to bottom in crude and start to push higher. It's been a big bear market in crude over the last few years. And, I don't sense that we're going to continue to punish these other countries for the supply. I know there's obviously a lot of different reasons why we want to do that. I believe the administration likely cut deals with Saudi, and I think the reasons why they'll keep supply a little bit on the high side in the next few months, but I don't think that's going to happen forever. I think that the Middle East makes money as crude goes higher.
Right.
The administration wants to keep inflation down, of course, and keeping crude down is helpful in that regard. But the cycles seem to say that the last couple of months could have a rise in crude. So I'm keeping sort of shorts a little tight to the vest there. I still think we have one big flush to the downside in energy. And I probably want to use that to buy, and thinking energy makes a lot of sense heading into 2026 as something to consider being long.
All right. That's, I was just going to ask. It sounds like you're saying it's smelling to you right now that end of the year might be a good buying opportunity, entry point into energy, especially
Yeah,
oil.
I
Yeah.
think that's right. Yeah. Historically, it's had a seasonally bad time from, end of the year into really January, February, and then it has a big spring into like this, so that's February through May is generally a great time to own energy and crude. And I think that's probably going to also prove to be the case, next year.
Okay. Um, all right. Well, look, crypto. Love to get your thoughts on that. And, I think you guys are all over the news these days about
Yep.
Ethereum. But feel free to talk about whatever cryptos have your attention most right now.
Yeah, it's interesting because with regards to crypto, you are starting to see evidence of altcoins really picking up steam, and that says to me a couple things. It means that the entire rally from late 2022 in crypto is probably nearing the last few innings. I haven't seen the sentiment yet, but obviously, as you said, to your point, I mean, it's all over the news and even our own efforts. Me being a technician, I try to ignore a lot of the news, but I my own target for Ethereum is 5,500, and for Bitcoin it's about 130,000. And I think in general I'm much more bullish on Ethereum over the next year than I am on Bitcoin. Bitcoin has begun to lose relative strength compared to many other cryptocurrencies. So, to your point about the meme stocks starting to kick into gear, I think we're also going to see that with regards to altcoins. There's going to be a lot of low-priced crypto that do quite well in the fourth quarter of this year that probably will be an interesting, something to watch with regards to sentiment, but it also means we're getting sort of late in the rally. So negative next year is far more negative for crypto. It is a cycle that historically has led Bitcoin down in 2022 and 2018 and 2014 and across the board. And so I think the time to be long is right now and really look to exit by end of year.
All right, so those targets that you shared, 5,500 for Ethereum, 130,000 for Bitcoin, those are sort of end of year 2025 targets?
I think that's probably going to happen in Ethereum sooner than later. I think it's probably October. And I think Bitcoin has also started to push higher lately. So I think we probably get there. And then we're going to have the same kind of pullback in crypto as we do in equities because the two still have a pretty remarkable degree of correlation.
Correlation.
Both
Yep.
bottomed on April 7th. You find tops and bottoms in both that have, it's more along the lines of what the eco-rated S&P more than the NASDAQ because we've largely gone sideways over the last couple months in Bitcoin. That's not dissimilar from the eco-rated S&P. But yeah, I sense that we're going to have a pullback that probably also happens in late October, November for crypto. And then you really want to buy dips probably even in bigger size to think that we're going to have our sort of final push up into year end.
All right. Well, Mark, look, we powered through all the questions I had for you. So last one for you before we wrap up. Is there anything else that's burning brightly on your radar, trend-wise, cycle-wise, asset-wise, that I haven't thought to ask you about that's important to talk about?
Um, yeah, I think we covered a lot of the major spots. Currencies, commodities, equities. I think the trend in social mood is unusual and very negative. And I think that is something to keep a close eye on. I don't know that there's any immediate fix to that, but things are getting worse. And, that's something that, ironically, from a contrarian perspective, is still probably pretty supportive of risk assets. And so that, it's an interesting time for the country, but with everything, a lot of this is cyclical, and we're in a very cyclical period to when this also happened back in Vietnam and a lot of the protests and the uprising and the upheaval. And it's really been a global issue. It's not really been an American issue. It's happening, and you could argue it's inequality that's causing this, but there's many. It's disturbing, and it's something that I think we all want to hope will moderate, in the months to come.
Okay. I'm just curious, are you familiar at all with Neil Howe's work, The Fourth Turning? You heard about that concept?
I have the book. I haven't. I need to probably revisit that. Yeah.
All right. Well, if and when you read it, or if you don't have the time, you can watch. I've done a number of interviews with Neil that you can watch.
Yeah, it's
Um,
one of those
it,
Kindle books. It's in my stack of things that I bought that I just haven't gotten around
yeah, well,
to.
I'm sure a guy like you consumes a ton of content, but if and when
Yeah,
you familiarize yourself with it, would love to hear your thoughts
of
as,
course.
as it relates to exactly what you just mentioned.
Yeah,
Um,
yeah.
All right. Well, so most important question in concluding here, for folks that have really enjoyed this conversation, Mark, maybe it's their first exposure to you. Where can they go to get to follow you and your work in between now and
Sure.
your next appearance on this channel?
So there's a few areas. One is just to go to fsinsight.com, which is franksaminsight.com. That's the retail. If you're a retail investor, you can go there and you go under our services. I do write a daily technical note. I have a video that's about anywhere from 7 to 10 minutes long. It talks about the market literally every single day and covers all different kinds of everything that's moving and not moving and why. So that could be interesting. Also, I'm on X on Mark Newton CMT. CMT, of course, is Chartered Market Technician, which is the sort of the badge of honor for those that do technical analysis. And so, feel free to go there. I don't often post a lot of actionable thoughts to people because I have 100,000 subscribe, whatever followers. And obviously we give most of my content to paying subscribers, but I do, retweet a lot of things. There's a lot of video content on there, and I do a lot with Fox and CNBC and Bloomberg and different media organizations. And so sometimes and Yahoo Finance. So sometimes I post content from my interviews there as well. So I would say, for those that are brand new, or maybe you're an institution, RIA, you can go to fundstrat.com. So we just celebrated our 11th anniversary, started in 2014, and, very happy about the growth.
Right here at the end, Mark. Okay, so as I describe these people, they're really, many of them have worked hard in their lives to build wealth. Obviously, they'd still like to increase that wealth while they can, but they want to do so with a good risk management in place. So any parting bits of advice to those folks, given the market conditions the way they are?
Look, I always think that diversification makes a lot of sense. I think, if anything, the pullback that we saw the first few months of this year gave many people an important and painful lesson that they were probably a little too overweight many technology stocks and really not as diversified as they should be. So never, keep your position sizes small and be well diversified. The next piece of advice is you always want to, as the saying goes, let the trend be your friend until
Mhm.
the end. And in this regard, I would say it's important to use things like a 10-month moving average. And if the S&P is above that and it's upward sloping, then you want to be long the market. When it dips down, and it did do that, not only, February of this year, early on for about 2 months, along with 2022. We had that during the major bear markets of 2000 to 2003 and 2007 to 2009, where the market stayed under it for almost 2 years. So when you start to see evidence of, these longer term moving averages be broken, that's a time to raise cash and be a little more cautious. But times when things are trending higher, generally it's important to just ignore a lot of the noise and what you hear from the media and concentrate on earnings and trends and sector rotation and what's happening.
All right, very, very good counsel. And I'm curious here. So from your methodology, it seems to me, sounds like you're generally you think there's a longer term expected total value if you ride the trend as long as it goes and then see that it breaks. And so let's say you pass the peak by, I'm making this up a number,
Yeah, yeah.
5, 7% or whatever. You're willing to lose that 5 or 7% because it's proving to you that the run is over versus trying to anticipate the peak and getting out too early because you might miss that it goes up by another 30%.
Yeah, that's very well said, Adam. I couldn't agree with you more. That's 100% correct. I mean, even on a small pullback, you don't really have sufficient evidence most times that we're starting a bear market. So things can carry up a lot further than many expect on both, I guess, the upside and also the downside. So you really just want to let trends be your guide. If you combine trend following with the fundamentals or with the macro or however you like to look at assets, I think you do yourself a world of good and service. And for those that come aboard with us, we're happy to educate you on how that process works and what we look at.
All right. Well, again, congratulations on a great year. And again, I really look forward to having you come back on in December to
Yep.
share your 2026 outlook with us. Thanks so
Excellent.
much, Mark. It's
Yeah.
been great.
Thank you. Yeah. Bye-bye.
All right. And everybody else, thanks so much for watching.